Among the seething mess of uncertainties surrounding Toshiba, one more likely path will involve its demotion to the second section of the Tokyo Stock Exchange, a small-cap board that lives in global investors' imagination as a Star Wars cantina of swashbucklers, villains, and lost souls. But is it really such a hellscape? Last Friday, the TSE2 index continued its steady ascent to an all-time high. The week before that, its stocks saw the biggest 5-session slug of foreign net buying since July 2013. Since the start of 2017, the TSE2 has risen more than 8%, against just 1% by the Topics, which tracks the TSE first section. Not bad for an index whose biggest names include a badminton racket maker, a kabuki theatre operator, and the fallen electronics giant, Sharp. One explanation is that TSE2 investors, many of them domestic retail, spotted earlier than everyone else a small cap exposure to Japanese growth that is only now being reflected in the numbers. Stocks in the Russell Nomura Japan Small Cap Index, which tracks a slightly different basket from TSE2, but with significant overlap, just posted collective year-on-year recurring profit growth of 19.2% in the third quarter of financial year 2016. Encouraging stuff for Japan, given that 77% of small-cap revenues originate at home. But there may be even more to the euphoria. Jesper Koll, the head of Wisdom Tree Japan, argues that despite the TSE2's image, small-cap outperformance may be driven by better corporate governance. Over the last decade, he says, Japanese small caps reported average annual dividend growth of 5.5% versus the 4% average logged by the large caps. And investors looking for future sources of cash distribution, says Mr. Koll, will also alight on the small caps. It is widely known that US, European and emerging market large caps have a lower percentage of cash to market cap than their Japanese counterparts. Less well known is that Japanese small caps eclipse the world with a ratio of 21.1%. A demotion to the TSE's second section would cause epic pain to Toshiba, but it would also spotlight a board emerging as the purest play on what Abenomics was supposed to be about all along: raising domestic growth and boosting shareholder returns.